Neil, what can the Fed say to calm investors down after another 500-point plunge here?
Well, I think they can continue to reiterate their data-dependent approach. And I think they need to, at a minimum, lower the path of interest rates in their dots plot, at least over the next year.
Scale back those projections.
Yeah, and I think they need to market their forecasts. I mean, the fact is that inflation hasn't actually been cooperating with their underlying goals. I mean, if you look at the 3-month change in the core PCE deflator that they look at, it's only running like barely 1% on a 3-month basis annualized. Rich Clarida recently talked about University of Michigan longer run inflation expectations. Those actually hooked back down. And he's also kind of revived looking at the tips market, which is something that I think was somewhat abandoned by Yellen. I think that the data and obviously what's gone on in the financial markets isn't really aligning, in my view, for a hike even in December. So I think if they want to be data dependent, particularly with what's happened on the inflation side in the U.S. and what's gone on globally with respect to growth, I think the market's sort of underestimating the likelihood of them just skipping the meeting altogether.
Diane, what's your expectation for next week? Do you think that the commentary is the most important aspect, and what exactly are you looking for?
Well, a couple of things. They are going to do a rate hike. It is just bringing rates up to basically zero real rates. Inflation on a core basis has picked up 0.5% over the last year. And what they're worried about is future inflation, forward-looking. That said, this is the Powell pivot. And what you're going to see is not only the statement pulling out of the gradualist language, additional gradual rate hikes, are to be expected. They're going to get themselves some flexibility. I think we're going to see the dots come down more in the 2 range than the 3 range to show that there is more concern about where rate hikes are going forward, but also there's a flexibility that Powell underscore in the press conference itself, and that is we've got a press conference after every meeting now. That means every meeting's live. They don't have to time, rate hikes or whatever comes to the actual quarterly forecast that they have, and they can really, on a more real-time basis, say how their views have evolved. The November minutes of that November meeting really revealed more downside risks that they discussed than upside risks, and being able to convey that on a real-time basis rather than waiting for the minutes to come out 3 weeks later is going to be very important going forward, because the Fed is not turning a deaf ear to the noise we hear in volatility in financial markets, and they're taking very seriously the role that uncertainty in everything from trade to global growth are playing in the outlook, and they're going to be treading much more cautiously in conveying that in the press conference as well.
I guess there's another view, though, Neil, that inflation and wage growth has picked up lately. The unemployment rate is at the lowest it's been in decades. Consumer spending is still looking healthy, and so is the economy. And the Fed probably doesn't want to get into this pattern where if the markets throw a tantrum, they just have to stop and completely reverse course.
But they're not. They wouldn't. No, they wouldn't be delaying because the markets are throwing a tantrum. Right. I think if you look at the data, they're delaying because you mentioned inflation going up. No, wages are going up. Price inflation, in fact, is not going up. If you look at, as I say,
so the data backs up a move to calm.
Well, not only that.
Hiking.
I mean, Sarah Eisen FX. I mean, look at dollar going up. The dollar's been steadily strengthening as the since their last meeting. That, again, they're supposed to be data and forecast dependent. If the dollar's strengthening, that introduces downside risk into their inflation forecast for next year. They have inflation actually accelerating for core PCE going into Q4 2019. And we know that the stronger dollar is going to put downward pressure on core goods.
Diane? The dollar?
Well, it's at the same time that we've got this sort of stagflationary issue of tariffs. And all of the tariffs, not only do we not know what's going to happen with the trade situation, we need rules of the road to move forward, which I think is one of the problems. We're sort of in a fog right now, and people are afraid to move forward and not knowing what the rules of the road are in terms of trade policy. But I think more importantly, that there's these countervailing winds. That wages have picked up. We've seen some slowdown in inflation. Some of that's really oil related. There's also some other issues that could be pushing inflation inflation up as we move into the year ahead. And I think it's very important to put into context, every client I talk to plans to try to raise their prices in January because of the squeeze on margins that will become much more apparent as the tax cuts play out on year-over-year profits in the first quarter. The Fed knows that too, and so they're trying to balance all these factors, but they're going to do so by also saying they're going to tread cautiously. So they're acknowledging the strength in the economy we've had, and then they're also acknowledging we're slowing down. The question is, how far will that slowdown go? They don't want to be behind the curve on the slowdown. They also don't want to be ahead of the curve in terms of not dealing with an economy that is showing some wage acceleration and could have more inflation because of the stagflationary nature. That's a really hard place for the Fed to be.